And we're with Dallas Native Live today. And my guest today is a return person that you all know and love, is Jason Browning with Academy Mortgage. And thanks so much for joining us. And as always, Candace is over there to the side watching our chat box. So throughout this program, if you have questions, please go to the chat box, not the question and answer, but the chat box, and write any questions in, and we will be glad to answer them. So today, Jason, I know you love these kind of, when I do this to you, I don't know that we have a specific direction, but I just want to talk about just loans in general, because it's such a, it's something, it's kind of like death and taxes, you know. It's, if you're going to buy a house, you probably are going to go get a loan. And so it's understanding the process. And so when I send a buyer to you, talk me through that. What's the next step? What can we expect? Because I think it's like going to the dentist. Just tell me what you're going to do, and I'll be okay with that. You know, just let's talk about it.
Okay, first off, do not compare me to the dentist. Okay, that is not a fun event. Buying a home is going to be exciting, I promise, and we're going to get you there with all the communication in the world. So that's a very good question. You know, I love it when you send the clients over to us. And our goal is to reach out to that particular client in 30 minutes or less, you know, because we know time is very important to everyone right now. And so that initial call is just more of a fact gathering call. We're just going to get a blueprint on what you're trying to accomplish. But, you know, before you go there and before you refer them, I know that you always say, hey, you want to have your ducks in a row before you call. So that's going to basically mean, you know, you're going to have to do an application. They're going to look at your credit report. They're going to ask you a few questions. And they're going to request a few documents. And if you have those documents together, then it's not really going to be a surprise when I say, hey, I need you to fill out an application. I need you to send over these few documents. And then it just makes that process much quicker for you, the home buyer, especially usually when you're ready to go, it's because you saw a home. And you don't want to really start the information gathering process after that. You really want to be ready to go. So you might be able to act quickly on your dream home.
Actually, you can't wait till you find the home, Jason. I want to make that really, really clear to everyone who is listening right now. If you are even thinking that you want to buy a home, your first call, after me, of course, is to Jason and to find out what you're qualified for, because there's no reason to go look at a $500,000 house if you're what you can afford and or are qualified for. And those are two different things. I'm going to talk about that too. But if you're if you're qualified for 400, then there's no reason to waste your time and get emotionally involved in a house at 500,000. It's not going to happen. So you have got to have all of your financial ducks in a row and get all of that stuff to Jason so that he can write a pre-approval letter, not pre-qualified, meaning I talk to you and I can breathe on glass. It is I have given him all the documents he needs to make a decision. So now take it from there, because I don't want you waiting till you find a house, because that house is already gone. It's not in this market. So sorry, go ahead.
Oh, no, I think you're perfect there. And one of the things that we do here with Academy is we do a pre-underwrite. We make sure that your loan is ready to go. So all we need to do is find a property. But back to that list that you're going to tell them. If you're a regular W-2 employee, you don't have any self-employment, you're really going to need 2 pay stubs, your driver's license, your last 2 years of W-2s, and then wherever the money is sitting for your down payment and closing costs. So the last 2 months of your bank statements, 401k, and those things. And just one other thing, if you are self-employed, you would obviously most likely take off the W-2s and the pay stubs, and we're just going to replace that with your last 2 years of tax returns.
Okay.
And then again, everything else is the same. And then just doing the application and you get a credit pull. And it's really that easy.
So someone that gets paid an hourly wage or a specific salary, W-2, gets a W-2 from their employer, they don't have to give you tax returns. That's interesting. I always assumed it was the 222s, the 2-year tax returns, 2 months of bank statements, and 2 pay stubs.
Yeah, since we do a little bit of a pre-underwrite, it allows us to say, do we need to go a little further on that and ask for tax returns? And in most cases, we're only going to need the most recent W-2, but we ask for both of those just in case. But usually it's the last the last W-2, last 2 pay stubs for a normal W-2 employee. And I will say this, just on the one-off, if you're the client that this happens to, you know, we do for checks and balances in this industry, You have a file that will be audited from time to time, and I don't mean that in a bad way. It just makes sure that we're doing our job and following the regulations. But they'll pick a file out and say, hey, this one we need to get tax returns on, and it's one out of every so many. But that could be one where you are a W-2 employee and we do need tax returns, but that's very few and far between.
Okay, good to know. So, okay, so I've called you, I need to get a loan, and you've walked me through the process. And one thing I do want to tell everyone who's listening, just because you qualify for XYZ doesn't mean that you're comfortable with that. So, I mean, they can come in and say, you're qualified to buy $1 million house. You're like, who's paying for that? I'm not buying $1 million, you know? So we look really good on paper. I think that's really the bottom line. When we put our credit score together, we look really good on paper, but that's not necessarily what you're comfortable with. So one of the things I really love about working with Jason is he can work forwards or backwards. So because I know, maybe I'm just too stupid, I don't know, but I don't understand what $300,000, $400,000, I don't really understand what that is. It's a number. It equates to nothing for me. So I really like that they can come to you and go, hey, Jason, you know, I'm really comfortable with a payment each month of $2,500. And so then you can take that and turn it into what would that loan amount be? How much have you saved to put down? And that's what we need to be buying, right? Yeah,
that's a very important thing to say there. You know, because when we talk to folks, we say, have you started your looking yet? Oh, yes, I'm looking online. I see these homes are 400, 500, 600,000. I said, well, how about this? Tell me what your budget looks like. How much are you wanting to spend on your mortgage every month? What's the max payment you want? And then we try to marry those two numbers. So if it's a $300,000 purchase and they want a $2,500 payment, you know, that's probably going to be somewhat close, maybe a little bit more than $300,000. But if someone says, hey, I want a $2,500 payment and you want to buy $1 million home, you know, we're going to have to back into those numbers and say, hey, this is what $1 million home looks like per month, and this is what $2,500 a month gets you. And that's eye-opening, you know. And again, the last thing you want to do is be house poor. You know, what I do hear a lot of the time is just say, tell me what the maximum amount am I pre-approved for? And I say, well, I'm going to give you the max payment as well, because what that is, that may not mirror up with what you want to pay. And a lot of the times that's extremely shocking. You know, I had a client yesterday, in fact, saw the dream house that she wanted, $1 million home, started getting all the warm and fuzzies about it, started imagining herself in the house and the furniture and all this. And she qualified for about $350,000. So that conversation beforehand would have been much more helpful for her. So she's not setting her sights on something that's just not within her plans, right. Her budget.
Or so, she has $700,000 to put down.
She did not, but yes, that would work as well. That would definitely work as well. But yeah, you just need to have those conversations, because sometimes someone says, I want this payment and I want this purchase price, and they do have $200,000 to put down. So you really just have to have that conversation, or you don't need quite that much money to get to what you're wanting to do. Right. So we'll break all those down in a total savings analysis for you, and it really puts it in black and white of what you can afford, what you want to afford, what you can purchase.
Yeah, and that's so important, and that's why talking to a lender before you get in someone's car to start looking is vital, because I mean, there's just no reason to fall in love with something you can't have. This process is stressful enough and emotional enough that, you just.
There's one other thing to put on top of that also. We talk about, make sure you talk to me before you get in there. But by talking to me also, it may open up more than you thought. It could be an eye-opening experience. Oh, I didn't realize that dollar amount per month would get me this. I was only thinking that. And it could be like, an aha moment of like, wow, that puts me in another bracket of homes that I could look at. It really works both ways. So it's a situation that you just need to invest a little bit of time in to know what you're getting into.
That's a really good point to throw out, because it's always interesting to me when we get a buyer and seller and they're butting heads over a couple of $1,000. It's like, this is what I want to do. This is what I want to do. And they're down to so little. Guys, per thousand right now with interest rates like they are, and correct me if I'm wrong, Jason, I believe it's $3.50 per thousand.
That's about right.
Is with right this second with interest rates the way they are, certainly no more than $4 per thousand. So that means that if I added $2,000 to my payment each month, it would cost me $8 more a month.
2 more
That's
thousand to your purchase price. Yes, that's right.
right. That's basically what it comes down to. So when I hear a buyer and seller fighting over such a small amount, now you can't keep throwing $4 at it, because pretty soon that $8 is now 16, and now it's right. So I get that. You can't just keep throwing $4 at it, but you're going to blow $4 at Starbucks. I mean, come on. And so if you really love this house and all we're apart is a couple of $1,000s, let's rethink that, because it's very little right now with interest rates so low per thousand. So like I said, you know, there's a difference between 1,000, 2,005 or 10,000. There's a big difference. And they might go out of qualifying for you, which I get that too. But really, when it starts fighting over such a small amount, it's always kind of laughable to me, because do you really want the house or not? We're talking a very little amount of money added to your monthly payment over a period of time. So so a question that came to me yesterday was, wow, I didn't know that there was going to be so much in closing costs to buy this house. And I thought, that's kind of interesting, because I don't really know that are we talking closing cost? Are we talking prepaids? Are we talking escrow? Because there's two different things in a closing statement, right? There's all the fees of the lender fees, the title fees, and all of that. And then there's kind of what I call your little checkbook that starts your escrows, which means taxes and insurance. So let's talk about that. Let's talk about the final closing statement and what that looks like. And then I want to go backwards, because I kind of interrupted the steps, what's going to happen during this loan process. So, you know me, I kind of saw a shiny penny and I went another direction. So
yes. So you're absolutely right. So, you know, again, one of the things that's caused a little bit of additional confusion is the new mortgage application that was just introduced in March. There used to be 2 line items that you would have that said, this is your prepaids, and then below that was your closing costs. And so there were 2 different line items. Now they're combined. So it is shocking when you see it. You don't know that there's 2 separate things. One is setting up the escrow account. One is paying for 1 year of homeowner's insurance, things like that. And then the other one is, it's going to have a list of all the closing costs that are there, but it's not going to have those broken down as to some of the ones that the seller typically picks up as well. That's on a separate line item. So it's just compounded, because you do have to list a charge, and then you have to list a credit on another page. So it kind of confuses you. And that's where our analysis comes in to be very helpful, because we give you the breakdown. Here's what's all being charged. Here's all the credits, and here's where this money is going. And then you said, and here's the down payment. Again, a lot of people don't know that's all inclusive of the down payment as well. So then they start kind of, get a little worried on, I got to do all this and the down payment, which is not the case. So.
Gotcha. And one of the things, when you talk about credit, I want to go back and pick up on that, because let's just say that we close on May 30th. So we're closing at the end of May, which is 5 months into the year. Well, the seller is going to be giving the buyer credit for those 5 months of taxes, because they live there. It's not the buyer's responsibility. However, the buyer's going to have to pay for the whole year's worth of taxes come December. Correct. January 30th, but basically they pay them in December. And so while it looks like a really large number that your lender is taking from you, which would be 5 months plus another probably 3 to really kind of start that little checkbook, they're taking 8 months of taxes from you. And that looks pretty hysterical. I mean, it's a large number. If you just go to the credit part of the closing statement, you'll see where they're giving you 5 months worth of credit for all of that. So really the lender's just taking about 3 months worth of taxes from you at closing. Between that and having your whole year of insurance due is a pretty sizable number. So so all of those closing costs, you start adding that together, it seems like a big number, but you do start getting credits, like for the taxes, they're part of the taxes, and for like your earnest money comes back to you, your option money, if you have any, comes back to you. So you start getting those credits back. So if you owed $10,000 for down payment, it starts to kind of eat away at that a little bit, or eat away at your closing cost, whichever. But I think a lot of people too, a lot of our clients were renters. And so they were used to paying the month of January and living there. Right. They paid for the month of February and they lived there. Well, a house is different. House works backwards. You live in the house for January and your February payment pays January. Right. You live there for February, March pays February. So everything works backwards. So when your taxes are due and your lender has to pay them in December, you haven't made your December payment yet. And the lender's not going to sit there and hope upon hope that you're going to make that payment, because if you don't, then they're out all that money. So that's why, one, they keep a little checkbook in there with a little extra money so that they can pay your things that are due before you've even paid for them. So I think that's what is a little confusing to buyers, is that, you know, why are you taking all of this from me? Well, because I'm going to have to pay stuff for you before you've paid me. Right. So it's just kind of, everything works backwards in a house, right?
Yeah, we do have that one situation, and we are getting into we've been in this environment for quite some time. I want to say it's probably like 6 or 8% of Americans put 20% down or more on homes nowadays. So much more, many more buyers nowadays are in a situation to where they have to escrow their taxes and insurance. But, you know, I talked to a client yesterday. He's putting 20% down. You don't have to escrow. The only thing you have to pay at that point is 1 year of homeowners insurance, and they don't even collect for those other things. But if you are putting less than 20% down, then you do have to have that escrow account, which is really it's protection for you and for the lender, honestly. So you want to get that $5,000 bill in December for the taxes, and then that $1,500 bill in March for the homeowners insurance.
Right.
Just put a piece of it aside every month.
Well, and that's the thing. If you are, someone who is diligent about saving, that every month you're putting a certain amount of money away for those taxes and that insurance, it's fine that you don't escrow it, meaning the mortgage company doesn't keep it for you and pay it for you. But you darn well better be aware that come January 1st, December 30th, or January 30th, you're going to have a chunk of change due for your property taxes. Depending on the price of your house, you figure 2.7%. Could be lower, could very well be lower. You can have your homestead and then it's even lower, but somewhere between 2.2 in some counties to about 2.7 is pretty much the taxes that are due based on the value of your home. And so, yeah, that can be a shocking amount. And if you don't get paid either bonuses or something like that, where you know you're going to get a chunk of change at one time to pay for that, it's something that you're going to have to be really diligent about putting it away each month so that you have the money there when it's ready to pay. So, that's kind of the difference of it there as well. So I want to go back to Candace. I saw some questions come through. Do we need to stop a second?
Yeah, if you don't mind, just a minute. I'm trying to get all of them on here. So, okay, so let's, I'll give you the top one. What is the mortgage rate right now?
So it's going to be dependent on the type of loan that you do. I mean, like if you're a veteran, you do a VA loan versus, doing an FHA or conventional. Pretty much, I would say we're in the low 3% range on most mortgages right now. Some of them will dip down just below 3%, but we are, kind of increasing a little bit here the last few days with the talk of inflation. So I would say just right around that 3 to maybe 3.25. And again, that's with excellent credit. And if if your credit's not quite as excellent, let's say a 680 or so, you're still going to be less than 3.5. So very, very aggressive rates at this point still.
I do want to caution everyone, and Jason will certainly back me up on this one. Rates change every day. And if the market gets volatile, meaning something's going on in this world that's making people be cautious or whatever that word is, I don't know. Rates can change during the day. They can absolutely change in the middle of a day. So just because Jason's telling you something is it right now, understand that tomorrow it can be something else. So when I tell my clients, all of you go to the same well for your water. It's not like you got one rate and someone else has another rate. They just don't. it is what it is. It's what the government, it's what the price is. Closing costs to me are what is a bigger deal of what, because some of these companies charge so many junk fees. It's astounding to me when I get some of these closing statements from lenders I don't know. I am floored about that. So more important to me to ask the question is, talk to me about closing costs, not so much about rates, because you need to be calling everybody within the same hour about rates as far as I'm concerned.
Yeah, I mean, I use that same term, fishing from the same pond. It's just how many layers do you have, and how much money do you have to put on top of that to get to that rate. So you're absolutely right there.
Yeah.
And you're right. I mean, we had a rate increase during the day yesterday. There was some volatility because of the talk of inflation yesterday. So I was on the phone with a client that we had just gotten a contract on, and we were doing a lock strategy call, and I said, hey, we need to lock your rate right this moment before an increase, and we did that. So we saved him from his rate going up. So that's something that we do in our process that we can talk about here in a moment as well.
Okay, Candace, do you have another question?
Yeah, so going along those same lines, how do they calculate a mortgage payment? Like what goes into calculating the total of it?
Yeah, so the things that are going to go into you have principal and interest, and again, that's all going to be driven from the amount of the loan. So you get a purchase price of $300. After you put your down payment down, you say you have a loan of $280. So everything's going to start at $280. So then you're going to look at that and say it's 3%. You're going to run that through a calculator, obviously, to give you your principal and interest. And then what's on top of there, depending on if you have your taxes and insurance included, which in this situation you would, your mortgage insurance, you have your taxes, your homeowner's insurance, and then if you're not putting 20% down, you may have mortgage insurance on a monthly basis as well. So those are going to be the items that come to the bottom line that you would write a check for each month. So principal, interest, taxes, insurance, and in some situations, mortgage insurance.
Okay. And then what if there's like a MUD or a PUD or HOA cost? How does that work?
That's a very good question. So the MUD and the PUD, those are all wrapped into your property taxes. So those are going to be inclusive of those 4 items I just talked about. Now, if you have an HOA, you're going to see it on the application itself. You'll see it as a line item as far as the debt goes, but it will not be written every month on your check to pay your mortgage. That is paid separately, either quarterly, monthly, annually to your HOA for those HOA dues. Some are higher than others, like a condo would have usually more, theirs are higher on a monthly basis than they would be if you're buying a single family residence. And sometimes, there's very few out there nowadays, but some areas don't have an HOA, so that would not be inclusive in your yearly outgo.
Right. Okay. And MUD tax and a PUD PID tax, those are different municipalities in our city have those taxes, and a lot of new construction have added those taxes because they're paying for the utilities to come in to the property and continue to come into the property. So they don't just come in once, continue to come in. And so when you're buying a property, it is the seller's responsibility to tell the buyer that those things exist. That's in our contracts. And so, and the same thing with new construction, it's a really good question to ask. Is there a MUD tax? Is there any additional tax on top of my regular property taxes? That's really the question to ask. In our older parts of town, it is, no, it doesn't exist. It's really, I'm seeing it a lot in our newer construction areas, especially.
Correct.
Yeah.
And if anybody has any questions about MUD or PID taxes, we actually have a definition of that and areas where that actually exists in DFW.
On our website, the Dallas website. Native, at dallasnative.com.
Yeah,
right.
And I'll link that on here. The other question is are closing costs negotiable?
That's a good question. You're paying for a service, or you're paying for insurance, things like that. So usually the closing costs from a lender standpoint, they're fixed because we're paying a processor, we're paying an underwriter. So those items are fixed. And some of the other fees, as far as like for an appraiser, those items are fixed because they have to get out there and appraise the property. And then your title company or title fees, those are going to usually, there's going to be some hard fees that are just hard and fast. It's 100 here, 300 here. But some of them are also in relationship to the loan amount. So they're percentages of the loan amount. So usually unless you know someone at a title company that's willing to give you a discount there, usually those fees are not negotiable, unfortunately. It's just you're paying for a service. That service costs whoever's offering it, and they've got to charge it in order to stay in business, unfortunately.
Yeah. It's kind of, I tell people, it's like you going into work one day and your boss says to you, Jason, you have just knocked it out of the park this month. And we're going to lower your salary. Okay. And you're going to go, wait, what? Yeah.
Come again?
Yeah. And so, or it'd be like going to your attorney going, would you draw up a will for me? Actually, I gave you everything to go into that will. All you had to do was type. So could you do that for less? It's the same principle, right? It's the same principle. So yeah.
I will add one thing to that as far as negotiable. So the fixed costs or those costs may not be negotiable, but I mean, there's ways to structure a loan, either from your standpoint, Mary Beth, where you try to ask the seller to maybe pick up some closing costs. We're not really in that environment right now, unfortunately, but you could also have that happen from the lender standpoint. So let's just say that you qualify for 3.25 on an interest rate, but let's say if you take 3.375, that's going to give you $2,000 off your closing costs. That's only going to move your monthly payment a very small amount, and it's going to give you some cash to pay closing costs. Those are some ways to get creative. But again, it doesn't work for everyone. I mean, everybody usually wants the lowest rate on the board, the lowest payment on the board, and then the seller wants a full dollar. But again, there are some very creative ways to lessen some of those costs.
Yeah. Do we have other questions, Candace?
Okay, so what credit do I need to get approved? I guess what credit score?
The credit score?
Mm-hmm.
So, loans right now, I mean, you can get a loan with a credit score as low as a 580. 580
Wow.
credit score, which, that's a little bit on the lower side. I would say excellent is going to be above 740, middle of the road, 680. And, kind of need some work, but still able to get a loan is going to be down to 580.
Wow.
And that's for an FHA loan.
That's low. Wow. Wow.
Okay.
Okay.
Okay, so what is the difference between an FHA and conventional loan?
Very good question. So the FHA is a government-backed loan. So they're going to, their rates sometimes are not so much, they don't change so much on your credit score like a conventional loan would. So if you have somebody that has maybe lower income or lower down payment, or has some dings on their credit report, an FHA loan might be the way to go. They have some extra charges that a conventional loan doesn't have. So they make their money up, but they also allow you to be a little bit more flexible, a little bit more aggressive on those things. A conventional loan, you're not going to have what they call a funding fee. Some of these fees that are on top of the loan for basically giving you the loan. So usually the stronger credit, 680, 660 and above, that's going to give you the better rates. And the higher the FICO score on a conventional loan, the better the rate. And then again, if you are required to have mortgage insurance, sometimes you can look at a loan side by side. You qualify for both with a 660 credit score. Well, yeah, look at the monthly mortgage insurance. That may skew which way you want to go as far as really how much you're going to write that check for each month. So those are the types of things that we talk about in the analysis to say, hey, what? You can do both these loans. You're going to qualify for both these loans, but this loan is smarter for you because it's the less, least the money out of pocket, maybe the lower rate, lower payment. So I'll give you that advice on which loan is the best way to go.
The other thing, speaking of giving advice, I also love that when my clients call you and maybe they aren't quite at a point where they can buy, you will coach them on if you will get this paid down to here, or if you can get this paid off altogether, or whatever, it will improve your score enough to get you where you need to go. So I really like that you don't just, you don't qualify, and then that's the end of the conversation. It's how can we get you there? What's it going to take, and what's the length of time it's going to take you to get there? So I always appreciate that too, that it's not just oh no, we can't do it. It's so sad, kind of conversation. So Candace, before I jump on to another conversation, which I will, what's our other questions here?
Yeah, so we have
good questions.
Yes, thank you guys. So the other question is how big of a down payment do I need? And I know that's going to vary depending, but that seems to be a general question that's being asked.
Yeah. So that's a very good question as well. And, again, that's also going to vary, are you a first time home buyer? Are you a veteran? Those types of things. So if you are a veteran, you can actually get a loan for no money down. And again, some people don't know that out there, that if you're a veteran and you've already bought a home and you're looking to buy another home, you can actually have more than one VA loan out at a time and still do zero money down. So there's some worksheets that we would work through on that to see about that. But typically, first-time home buyer, you're going to be able to put 3% down on a conventional loan, ideally 5%, but you can go as low as 3% in some situations. And then on the FHA loan, their minimum down is 3.5% of the purchase price.
Okay.
And one thing we haven't talked about, and I don't really want to get into it too greatly, but there are other programs out there like the Hometown Hero program, which is really near and dear to my heart, which is both for any first responders, veterans, teachers are pretty much first responders these days, aren't they? Nurses, doctors, police, firefighters. I don't know if I've missed anyone in that group, but it's a really cool program, that Hometown Hero program, and that has its own set of rules and less down and all of that. So it's if you fit into any of those categories, it would be worth your talking to Jason about and mentioning that you are in one of those categories, and see what kind of loan that is for you. I think there's some really cool things about that. Candace, anything else, or are we moving on here?
Yeah, so there's a question of, what are mortgage points and do I need to pay them down?
That's a very good one as well. So mortgage points, if you do your online looking, I'm not going to name the online lender there, but you'll see these rates. I mean, it's really kind of clickbait, really. They want you to click and then go down the rabbit hole. But you'll see these rates they seem too good to be true. Well, they are. And the reason that they are is, in the very fine print, they're going to say we're charging you 2 points. So basically what a point is a 1%. If it's 1 point, it's 1% of the loan amount. So say your mortgage is $300,000. Well, you're going to pay $3,000 in additional closing costs to drop that rate, whatever that might be. So my stance on it, if you're trying to get to a certain payment and that payment is just, you've got to get there, and the only way to get there is to pay a point, then great, we can do that. But my overall stance on that is, money is so inexpensive right now. The cost of our funds are so cheap. It's almost free. And it's, the time that it would take you to recoup the payment of that point, with the difference in the savings per month, would be maybe longer than you're in the home itself. So I recommend no points unless it's just absolutely necessary. Our money's almost free as it is. And really, by paying those points, you're not really knocking your payment that much lower. Even hey, I'm under 3% on the rate, but you're only going down $17 a month, and it's costing you $3,000. That math just does not add up.
Right.
But I would put it out there for you. Put it on paper, let you see it. You can make that ultimate decision. But me, I would not recommend paying points. And again, if you're seeing a rate that's just really crazy low, I guarantee you there's a 0.2 or 3 in there. They just have it very small and very fine print, just to get your attention.
Yeah, I've always said, if it looks too good to be true, it's because it is. Right. But also, if you think of points as prepaid interest, if you kind of think about it that way, you're just paying that up front. It's the old pay me now or pay me later. You're going to pay me. So while it looks really good, other than bragging rights to say I got 2% something interest, it's kind of like refinancing your home. The cost of refinancing, and let's just say it changed your payment, when we make it easy, $10 a month. Then you take that $10, divide it into the amount it's costing you to get that money. How many months is it going to take you to eat that up? And it's usually the ends don't justify the means there. It just doesn't. And that's really what Jason's saying, is you take that prepaid money of $3,000 or whatever it is, and it changed your payment by $25 a month or something. It just doesn't add up. It just doesn't compute. So yeah.
Good question.
Yeah, it was a good question.
No, we're good right now.
Okay. All right. So I want to go back to, because I can't imagine that we interrupted you in what you were talking about the process. So I've come to you get the loan, and you've done the search. What can I expect through the process? How does this work?
Yeah, so very good. So as we talked about getting those documents to us, We're going to pull the credit. We're going to put together our total savings analysis for you. We're going to schedule what I call a mortgage planning session. And that's going to be a virtual meeting between me and the purchaser, whoever's involved in the major decision. So used to do it face-to-face. We've gone virtual now. So I'll share my screen with you. We'll walk through all the details of that total savings analysis, price points, monthly payments, closing costs, meet your budget, meet what the purchase price you're looking for. And then before I send you on your way after that call, I'm going to send you a pre-approval letter. Again, we've already underwritten the file as well. So basically all the heavy lifting is done. So at that point, I send that letter to you. I send it to Mary Beth. You guys start house hunting. And then at that point, you find the home, you make an offer. I reach out to the listing agent, the person selling the property. I talk about how strong your offer is, that your loan has already been pre-underwritten. Talk about our timelines on closing loans quickly. Also talk about our communication. So not only will you receive an email as the client and the agents also receive this about every major milestone, like once you go into processing, once your appraisal is ordered, once you've been into underwriting, those milestones, those major milestones, everybody gets an email on that. So you really know what's going on with the loan at all times. But also I will call everybody involved once a week, the client, both agents, to give them a verbal update once a week. So they absolutely appreciate that. Not a lot of lenders do that. But I just let them know where we're sitting and how close we are to the finish line. And the more you communicate, the more comfortable they are, and everything just continues to flow smoothly. So again, processing, underwriting, closing, and really all those things, we can do it. My average right now is probably about 25 days from the time you go under contract until we're final approved, maybe a little bit faster. And then again, it's just most contracts are written about 30 days. But then again, once we get all that stuff done, we send the documents to title. We send a document to you that shows you all the breakdown of all the numbers. So like Mary Beth was stating a moment ago, here's all the cost, and then down on page 3, here's all the credits, and then there's the bottom line, what you'll be bringing to the closing, and that's inclusive of down payments, credits, closing costs, everything. So, and again, that can be done, anywhere from 19 to 25 days, honestly.
Yeah, I love that they bury the good news of credits on the last page. It's like, for me, that should have been right up front. This is what I'm getting, and now here's what I owe. They need to change that. Who do I need to talk to get that changed? For burying the good news, that's not good. So, let me think. What have I not asked you? Loans are just such.
Let's talk about appraisals for a minute.
Oh, okay.
So, what we do. For us, that's the only upfront out-of-pocket expense that you'll pay. You'll pay everything else at closing, but we ask you to pay for that appraisal. A lot of these appraisers are not going to put you on their calendar until you pay them. And so they're taking anywhere from 7 business days to 12 business days. So the sooner you get on the calendar, the better. So we send you that link right after you sign disclosures. You pay for it. And again, all of our appraisers, the panel that we put together, they're all local. They know the neighborhood. They're able to get out there. The one thing that a lot of folks are worried about is these, putting their offer in over asking price. We're just now getting to that time frame where that's been going on long enough to where those other homes that were doing that have sold. We're having comparable sales now. So we're starting to get our appraisals that I haven't had any low ones, to be honest with you, knock on wood, but there's situations where people are offering a significant amount over the asking price. Well, the comparables are catching up with that. So the chance of having a low appraisal or the delta being much lower are happening now because we have the inventory of sold homes as comparable sales, if that makes sense. And you can add to that too, Mary Beth, if you'd like.
Yeah, we just had an appraiser talk to us at an office meeting on Monday, and it is finally happening where, appraisers are looking backwards 6 months. We're looking forwards to what's happening right now. And so, yeah, the two are finally coming together. So yes, a house might have been priced at $300 and someone paid $350. $350 is what goes in as the sales price. And that's what the appraiser now can use for that neighborhood. And each subsequent sale is just pushing our values up in every neighborhood. And I've always said, even in a normal market, there's always going to be a house that sets the market. It's because it is drop dead to die for. It's standing at attention. It's at 2021 standards. It's got all the updates and all the bells and whistles, and everything's been updated. And so it now sets the bar, and it allows the lesser houses to kind of creep up a little bit.
Sure.
Otherwise, we'd have flat line. pricing for forever. It would never go up. So even in back in the old days, like 6 months ago, there was always that house that set the tone. And now each subsequent sale that's going over asking price with appraisal waivers, so that it doesn't matter what the appraiser says, they've agreed to buy and bring the extra money to the table. And I do want to talk about that next. It's setting a new tone. It's setting our new numbers. And so it resets now to that. So let's talk about this appraisal waiver. So let's just say, I'll just make numbers easy here for a second. Buying a house for $300,000, we came in at $350,000. We were always going to put 20% down. So we were always going to put the $60,000 down on this $300,000 house, right? Okay, take it from there and tell me how this works.
Yeah, so let's say that the appraisal actually comes in at $340,000. Let's just say that we don't hit that, right? We're $10,000 light. So there's a couple things that we can do there. We can take that additional, you're going to put 20% down there, and you don't have to. So that's more money than is absolutely required to put down on the loan. You can take $10,000 out of that, and then still go around the financing, with the way we initially had it work. Your new down payment percentage is going to be off the lower of the appraisal or the purchase price. So all of your numbers reset down to that $340,000. And then again, or if you just have the extra cash, you can still put your 20% down. You can bring the extra 10 to closing. But again, that's where we kind of get creative and say, you don't have to put 20 down. We can take 10,000 out of that, put it over here, and continue on with the loan as we currently have it constituted. So we can get real creative on that. But that's basically the difference. When you do this appraisal waiver, you're basically saying whatever it doesn't appraise for the difference, I'm going to bring that to closing, whether we restructure the loan or you just have the money sitting in the bank.
Okay, do I need to, I as a borrower would need to show you at that point that I have the additional $30,000 to bring to closing?
Absolutely.
So, because I'm going to have my 20% down, let's just leave it at my $60,000. I was going to put down 20%, and now I need to bring an additional $30,000. So now I need to bring $90,000 for just my down payment alone, right?
That's correct.
Okay, so so I just need to show you where that money is coming from.
Yeah, you can't take a picture of the money that's under your couch. You would actually have to show that those monies are accounted for. Paper trail 60 days in whatever account they're sitting in. But yes, you would want to have that alongside the other monies that you previously showed us for your down payment and closing costs. Absolutely.
Okay, well, Grandma's going to give me that money. Grandma's so wealthy. Grandma's got the dough here. So Grandma's going to give me the extra $30,000. So how do I do that?
Actually, a couple ways of working on it, as long as it's money in an account, right? It's not under her couch as well. But if it's in a checking, savings, whatever, there's two ways we can go about that. We'll always need to get a gift letter. My grandmother's given to the grandson X amount of dollars that's coming from X account, signed and dated. There's no repayment. It is a gift, right? And then we would want to get her last 2 months of bank statements, and then get your bank statement showing where those monies entered your account, and that's it. And there's also one other way on a conventional loan. You can actually have the gift letter, grandma gifting to the son X amount of dollars. You send it straight to the title company, so you bypass the borrower. So you don't have to show it going into their account, going out of their account, those types of things. A lot less paperwork. And we don't have to get the grandmother's last 2 months bank statements. We just get the gift letter, and we get the wire receipt from the title company that shows that they received the money. And that's on a conventional loan only. But if you're doing an FHA or VA, you have to have the 2 month paper trail all the way around. But there's some ways to get creative with that.
Okay. So it's okay that you're getting a gift. You just need to show where the gift comes from. I think at the end of the day, when y'all keep asking questions and asking questions and asking questions, it's like, what do you want, my firstborn? Or blood? What do you want? I think at the end of the day, the question is, did someone go get a loan for that additional money? Yes. And that's what the no-no is. You can't have a loan with this loan.
Right.
Somewhere down the road.
Borrow money to borrow money.
Exactly. Somewhere down this chain.
Unless it's your own money. 401k, home equity loan of your own property. Yes, those are doable, but you can't borrow money from someone else to borrow money for a home.
Right. Somewhere down the road, someone needs to have some money. And that's when they ask the questions or keep asking for more documentation, the bottom line question is, did someone borrow that money, or did they already have it? And that's really the important question there.
Yeah. And to add to that, what we're looking for is, if something was given to us, did something change? Was something that was provided beg an additional question? We have all these services behind the scenes, and we probably have about, there's so many people, have their hands in the cookie jar and doing a mortgage. 20 different people when you're talking about a lender, title company, both realtors, the buyer, the seller, all those different folks. And did something change along the way? Do we have to ask for one more piece of documentation? Did you do something? Did you go out and apply for a car? Did you get a car? Did you get a credit card? We have these services that kind of monitor things behind the scenes, and we'll know if you have your credit pulled. Right before we close, it says, hey, there's an undisclosed debt. We got to go get the paperwork for that.
Right.
So that'll be some of the advice that you'll have, that we'll give you. Hey, don't go buy anything. Don't open any, wait till you move in to go get the fridge and the couch. Those types of things. We'll have those conversations about the do's and don'ts. But again, did something change to where we have to, basically look into the ability to repay? And if nothing changes, usually what we ask for the first time, we stick with that. But if something else changes and it begs another question, that's when we would come back and ask for additional documentation or explanation.
Yeah, I don't think people realize that you will pull that credit report again before closing.
It's not really a pull. It's just a monitor. So right. They actually have it's almost like having their finger on the pulse. If it goes up, we know about it, because we monitor those things, and it's basically say, if you went and bought a car, now you can't afford your mortgage. We need to know that before closing. So not truly a pull, but a monitor.
Right. So, and two, they will also verify your employment. So if you're going to be losing your job, and I've had that with one of my clients.
Yes.
They lost their job just before closing, and you can't fake that. They're going to call and say, hey, is Fred still working here? And the answer better be yes. And so
back right now in the day of COVID, they do one about 10 days before closing, and they'll do one the day of closing. Because of COVID. COVID really has kind of shifted this quite a bit. But that's why they want to make sure that, again, it's all about the ability to repay. If you're employed, nothing's changed there, smooth sailing.
Yeah. And that really, like you said, that is the bottom line, is, can you afford this house? The lender doesn't want to sell you something you can't pay for. And none of us do either. I always laughingly say when someone calls and says, hey, we got a beach house, let's go down to the beach. And you're like, but I just bought a house. No, I want to go to the beach and I want the house. I don't want you to be, I just bought a house and my whole life is that. None of us want that for you. None of us. And so, like I said, just because you're qualified to buy this doesn't mean you're comfortable buying this. You might want to be here, and that's okay. But if we don't know that, then we can't help you look for houses. We're looking for houses up here, when in fact what you're comfortable with is down there. And there's no bad thing here. There's no, oh, that's all you can afford. None of us look at it that way. It's just, that's what you're comfortable with. And we all have that point of where we're comfortable. That's just all there is to it. Like, I want to know that I can go travel and go do whatever else I want to do. And I want that for you as well. So Candace, do we have any other questions? So we're kind of coming to the end of our time here.
We are, we need to start wrapping things up a little bit, but we do have one other question. What documents do I need to provide to get a home loan?
Okay, very simple. If you're self-employed, let's go backwards. If you're a W-2 standard wage earner, I'm going to need your driver's license. I'm going to need your last 2 pay stubs. I'm going to need your last 2 years of W-2s, and I'm going to need your last 2 months of bank statements and an application. That's it. If you're self-employed, we take a couple of those off and we add another one. So if you're self-employed, driver's license, I need your last 2 years of tax returns. I need your asset statements, bank statements, and that's it.
A question as I just sitting here hearing you say that, if I can't find my 2 years worth of W-2s, I guess by providing you my tax return, you could see that, right? Actually,
we would do that. That would help us, but that actually, we want to try to go the path of least resistance and not introduce more than we need. So what we would do in that situation is we can ping, again, we don't like to do this because the IRS, especially this time of year, is extremely busy. But we can ping the IRS, or you can actually go to the IRS.gov site and download your W-2 transcripts, not your tax transcripts, but W-2 transcripts. You can download those and you can provide those as well. So there's 2 ways to get those. It's faster if you do it, because we have to go through a formal process being a lender. You can do it much, much quicker, but you can do that if you cannot locate your W-2s.
Good to know. See, I learn something new every time I talk to you. It's like, wow, I didn't know that. Okay. And I know Candace, having been through the loan process, probably more recent than any of us, will tell you all is like, you will get asked for the same paper again and again and again. And it is so frustrating because I gave it to you, but then it went to the underwriter, and then it went to the processor, and then it went to whoever else is there in a room with no doors and no windows. And somewhere along the line, that paper didn't get transferred. So our suggestion for you is to get a folder and keep it with you all the time. And every time they ask for a document, put it in that folder so that
ideally we ask for it one time and that's it. But there are the one-offs where, this particular person was out of the office on vacation and it's in their inbox. So we need to get it again. But that's, for us at Academy Mortgage, we usually do not ask for the same document more than once. Again, if something changes there, we may ask for a newer version of that document. But the same document, usually we're good. But again, the one-offs do happen. And again, you're buying the biggest investment of your life, right? So we want to make sure that you're going to be able to pay the bill. And that's the bottom line. Two extra documents, that's what we'll do.
I think when all the questions get asked at the end of the day, that's the question is, can you afford this house over this period of time? 30 years is a long time. I don't know about you guys, but 30 years is a really long time. And most of us don't stay in our houses for 30 years. We know that. But should you stay in the house for 30 years? I mean, our parents did. Can you afford it? That's really the bottom line. So before I shut this down, Candace, any other questions, or do we cover everything? So really great questions today.
Yeah, really good questions, and we are done.
Okay, super. Well, thank you so much for listening. If you need any more information, Candace will put in the chat box how to reach Jason or how to reach us. You can always go to our dallasnative.com site and you will find Jason's information there as well. And just all kinds of information about loans and the PIDs and the MUDs and the taxes and all of that stuff is somewhere on our site because we are everything Dallas. So when I say Dallas, I mean the whole Metroplex, the Dallas, Fort Worth, Collin, Rockwall, Denton, all of those areas. We kind of cover it all. So Jason, any last words?
Well, no, just again, don't wait until that last moment to get to start the process, because again, when you find that home, if you're not ready, it could be gone. The other thing is, Mary Beth and Candace, thanks again for having me. I always love coming on your show, and I just look forward to talking to your future clients here. And you guys have a wonderful afternoon.
You too. Thanks so much for listening.
Bye.
Bye.